Exercise 6-21. We're going to talk about the lower of cost or market rule for inventory. Let's say we're going to go into business and we plan to sell goldfish walkers. Yes, this is a real product, and no, it did not sell very well. The purpose of this is to put your goldfish in here and you take it for a walk. Who knows why no one wanted to buy it. Anyway, let's say we buy $10,000 of these with the expectation that we're going to be able to sell them for a higher price. So our inventory records show that we have $10,000 worth of inventory. Let's say a year goes by and we've not sold a single one of these. So it's the end of the year, and our inventory record, which is going to appear on our balance sheet since it's an asset, shows that we have $10,000 of inventory. And that, of course, is the cost to us. Now, is that a valid number? Do we really have $10,000 worth of inventory on our books if we can't sell a single one? No. So that's where this rule comes in, the lower of cost or market rule. Now, this applies to inventory. What this means is at the end of the period, you have to show your inventory at the lower of the inventory's cost, in which in this case, in this example, it's $10,000, or the market value, whichever is lower. Accountants need to be conservative. That's why it's the lower of these two. So we have to lower our inventory value from $10,000 to $500. And this would be an adjustment, an adjusting entry. The other account that would be affected would be cost of goods sold, because this is part of the cost of doing business when you have to lower your value of your inventory. Some people call this writing down your inventory to the lower of the cost of the inventory or the market value. Now, this example, the goldfish walker, while true, is kind of extreme, but lots of inventory will lose value over time if you don't sell it, such as computers. Computer technology advances, and if you got a year-old computer that you've not sold, it's probably worth less. So let's get to exercise 6-21. Rapid Resources, which uses the FIFO, first in, first out inventory costing method, has the following account balances as of the end of May, prior to releasing the financial statements for the year. So their year end is the end of May. So this company is going to have to show or they're going to create their financial statements, which of course includes the income statement, also called the profit and loss, P&L, and the balance sheet. Now the balance sheet is going to show the inventory. So here's our inventory. On our books, in other words, our accounting records, it says that our inventory cost us $14,500. So what we have to do at the end of the year is see what the market value of that inventory is. And if it's lower than the cost, we have to write it down. In other words, lower the value of that asset. So Rapid has determined that the current replacement cost, in other words, that's the current market value, as of the end of the May, for the inventory is actually $13,500. So according to this lower of cost or market rule, we have to write it down to the lower of $14,500 or $13,500. Which one is lower? Obviously, $13,500 is lower. So I'm going to show you some T accounts that I put in Excel. You could always do this just in a piece of scratch paper. You don't have to use Excel. So I'm showing the lower of cost or market value, which means you're going to do an adjusting entry for inventory at the end of the period. So here's my inventory. Obviously, inventory is an asset, so I put the plus on the left side, the minus on the credit side. And I've taken this $14,500 up here and placed it here. So this is what our books show before the adjustment. It shows that our inventory is worth $14,500, or I should say the cost was $14,500. But according to this, the value of the inventory, the market value, what you could purchase it at, that's what market value means, is only $13,500. So here's what we have to do. We have to go down here to inventory, and the ending value of inventory should be $13,500. So how am I going to adjust this account to go from 14,500 down to 13,500? Now remember, the adjustment is going to make the account either go up or down. In this case, we have to go from 14,500 to 13,500. So that means we have to lower, which is why I'm putting it on the credit side, the account by $1,000. So now I have the the credit account for my adjustment. And for every journal entry, and that's what adjustments are, they're journal entries, a type of journal entry, we need a debit and a credit. So what account are we going to debit $1,000? Well, whenever we're lowering the value of inventory due to the lower of cost or market value, the other account is always going to be cost of goods sold. So the reason I have $70,000 here is because that was the balance of cost of goods sold according to our instructions. And since this adjustment was lowering inventory by $1,000 with a credit, we need a debit. So we need to debit cost of goods sold $1,000, which is an expense, of course. And if the boss asked us, well, how much is our cost of goods sold after the adjustment, it would be $71,000. But this problem does not ask us for that information. So now let's go see what they're asking us to do. It says prepare any adjusting journal entry required from the given information. Record debits first, then credits. No kidding. Select explanation. For situations that do not require an entry, make sure to select no entry required. All right, but we do need an entry because the value of the inventory on our books is $14,500, but the replacement value is $13,500, so we need to do this adjustment to lower the value of inventory down to $13,500. So let's get back to our T accounts. So the way we adjusted it is we lowered inventory with a credit, and we increased COGS with a debit. We have to do the debits first, so I'm going to debit COGS for $1,000. Cost of goods sold. And then the other account, of course, is inventory going down with a credit. So that is why I'm crediting inventory. And the explanation is to write merchandise inventory down to market value. Now, it says what value would Rapid report on the balance sheet for inventory? So, going back to our T accounts, it's easy to see what the value of inventory is. It's the ending balance. We had $14,500. We wrote it down by $1,000, which just means we lowered it. And the ending balance is $13,500. And why did we write it down? According to the lower of cost or market rule, Rapid Resources should report inventory on the May 31 balance sheet at $13,500. The lower of cost or market. And that's it.